Good day, grade 12 learners. Welcome to today's economics lesson. I am Letiane LG, and this lesson is brought to you by the Free State Department of Education in collaboration with Pagama Research and Development. Okay, grade 12s, as part of the revision. Today we'll be looking at the first topic that we did when we entered into grade 12, and that is called the circular flow. It is one of the lighter topics, therefore, but we'll be looking at the technicalities, especially when we answer certain questions in this, because we always expect that since this topic is a content progression from the lower grades up until now in grade 12, where in grade 12 we do everything. But there are still those minor technicalities when we are answering certain questions. Therefore, this lesson will be focusing on especially the key concepts that will assist us as to how to answer certain questions or part of the essay, especially when you start the introduction, and section B as well, where we said briefly describe the concept. And remember that these concepts, grade 12s, are there in section A, where we expect a learner there to get 30 out of 30 in paper 1 or in paper 2. Okay, this circular flow model, it's a continuous flow of spending, production, and income between different sectors, or you can say between different participants. Then you will also be asked to say, what are those different participants in the circular flow? Now you'll be saying this with me. Those participants are the households, which are the primary participants, followed by firms and government, as well as the foreign sector, if we'll be talking about the four-sector model. Then we started first by building up the economy, where we started with the two-sector model. In a two-sector model, we focused on households as well as firms. Then we moved now to a three-sector model where we included the state or the government. In that way, that economy was referred to as a closed economy, where we said a closed economy or a three-sector economy. It is the one that has got no foreign sector as a participant. Okay? An open economy now. An open economy is the one that trade with or the one that includes the foreign sector. So you've got a four-sector model or a four-sector economy. I repeat, when we started, you start with the two participants first, where there's no government intervention. The only participants that we have is households as well as the firms. Then we moved on, now we added the state or the government for many different reasons for that matter. And it was referred to as a three-sector model or a three-sector economy or a closed economy. Why closed? It was movement of goods and services as well as spending was only happening within the borders of South Africa, not outside world. But when we come to the four-sector model, we included a fourth participant there, which that participant, we said it is the foreign sector. So now we are opening to trade with other countries. Hence, it is referred to as an open economy. So a simple question. If you see a diagram of a circular flow that has got households, government, businesses, and then they ask you for 1 mark, what kind of economy is depicted above? The answer would be, it is a closed economy or a three-sector economy. Why? Because it does not include the foreign sector. But in a situation where you see all the four participants involved, which is the government, the households, the firms, as well as the foreign sector, that one therefore is referred to as an open economy. Reason being, now it includes the foreign sector. Then we come to the issue of consumption. Here it refers to the spending by the population or the buying or the purchasing of those goods and services. That is referred to as consumption. Then another concept that we are having there, it is autonomous consumption. Here we are saying it is the expenditure that will take place or that will happen even when the level of income is zero. Where we are saying such consumption is considered to be autonomous of income only when expenditure of those consumables does not vary with the change in income. So here, according to the classification of unemployment, you are regarded as a person who's not working, but you still be able to eat. You are still purchasing those goods and services. Now, question would be, where do you get the money from? You get the money through social transfer. I'm talking about grants in this case, maybe child grant, support grant, disability grant, old age, and the one that was introduced, the relief stress grant. Usually you call it a 350 or 370 based on the current amount. Those are part of the amount that will make you to spend, while we know that you don't receive a fixed income. So those are classified as what? Autonomous consumption, because consumption will still take place even when the level of income is zero. So it is referred to as autonomous consumption. The difference, the opposite of autonomous consumption is what we call an induced consumption. So that one, it depends on the level of income. This one, we said it will expenditure or consumption will occur or take place even when the level of income is zero. That is called what? Autonomous consumption. And the opposite of autonomous consumption will be an induced consumption. This one is dependent to income. It will take place as income increases or as you receive a certain income. Okay. Then we've got what we call the domestic figures, or they are well known as GDP. Okay. Very funny enough here, when you ask a person, what is GDP? They say gross domestic product. Then you ask them, what is gross domestic product? They say GDP. We don't say the abbreviation, but description, the concept, the definition, therefore. Okay. So it is the final value or the value of all final goods and services produced within the borders of a country for a specific period. It is the gross domestic product. The final, those are what we want to see when you are defining it. The value of all final goods and services produced within the borders of a country. Those are some of the keywords that we want to see. And they are known as what? The domestic figures or gross domestic product, abbreviated to be GDP. We also have what we call national figures or gross national product. These two concepts are too close to each other, especially if you are in a hurry. You might mistake the other one for the other one. But look at the keywords here, grade 12s. With that one of domestic product, it just says value of all final goods and services produced within the borders of a country for a specific period. This one, it starts the same as the other one. The value of all final goods and services produced, here is the key word here, by permanent citizens of a country for a specific period of time. Okay, do you see now? So national figures, we only focus on those that we say, these are the permanent citizens of a country. They will give us what we call national figures. I'll make an example. South Africa, we know that it is a diverse country. So we will have someone who's not a South African citizen, but working in South Africa for that matter. Let's say we'll have someone from Swaziland come work in South Africa. That person will be counted, his contribution will be counted when we are calculating the GDP of a country, because we are looking at the domestic production of all goods and services within the country. However, when we calculate national figures, we will exclude non-South African citizens. Hope this is clear, grade 12s. The national figures here, we are only looking at permanent citizens of a country. So when we ask you to say, briefly describe the concept gross national product, you will start it to say, this is the value of all final goods and services produced by permanent citizens of a country. Okay, I made an example. Got someone from Botswana working in South Africa. That person, in the GDP, that person will be included. But in the GNP, that person will be excluded because that person is just working in the country but is not a permanent citizen. Okay, then the net figures here, they indicate the amount that has been taken away. For example, the net exports will reflect the value of exports after you have less the what? The imports. Remember the current account is the balance of payments. We want to check how much of the exports are going out and the value that we are receiving, as well as how much of the imports are coming in and the value that goes out. The difference there will give us what we call the net figures. If it's negative, that tells us that there is more imports coming into the country, more money is going out. If it's positive, that tells us that there is more of the exports going out and less of the imports coming in. Those are the net figures there. Okay. Then we've got what we call a national accounts or system of national accounts. These are part of the macroeconomics that consists of the accounting records of a country, where we look at the three method of calculating GDP. Those refers to the production method, the income method, and the expenditure method. You call it PI, in other words, where the P stand for production, the I stand for income, and then the E stand for expenditure. So that is the accounting records of a country's total production, income, and expenditure. Okay. Then we look at what we call subsidies on production. The catch here, hence we are saying we are looking at the technicalities. We know what are subsidies, but these subsidies come in parts and parts. There is subsidies for a specific purpose, and there's subsidies. There's subsidies on products, there's subsidies on employment, there's subsidies on education, there's subsidies. So we need to understand what kind of subsidy are we referring to here. So we're looking at subsidies on production, where we say this refers to subsidies that are not linked to any specific goods or a service. For example, subsidies that are made on employment. If the country realizes that there is an increased unemployment figures in the country, but there are industries or firms that are willing to employ them, but you'll find that those firms do not have capacity. They will apply to the government, applying for what? For subsidies on relief. And then that money is going to be used to pay the employees. If you remember, during the COVID times, we see a point where we didn't want the businesses to totally shut down. Hence, the businesses have to apply for subsidies from the government, and they pay a certain amount while the other amount comes from the government so that the production can take place. So another way you could be saying these are subsidies that are there to encourage the production of goods and services. Opposite to subsidies on production, we've got subsidies on products. These are the financial incentives that are there to help struggling industries to produce, as well as direct subsidies that are payable per unit of exported goods and services, or also to encourage what? Exports. For example, subsidies on bread. This one affects you and I as the consumer. So if the government provides subsidies on products, they want these basic goods to continue to be produced, a continuous production of this basic good. Then after that, we know that once there are subsidies that are involved, the end product will be cheaper, so that you and I will be able to do what? To afford. Those are the subsidies on product. Okay. Taxes on production. It refers to the taxes on production that are not linked to any specific good or service. It means at the end of the final product, we cannot see how much government actually put in. But the firms know that for us to be surviving, it is because we were assisted by the government. That's the subsidy. And also looking at in terms of the issue of taxes, we cannot actually see that, but these are not linked to a specific good or a service. Hence, we are looking at tax on land and buildings there. The one that you and I know is this one, taxes on products, where we are saying these are the taxes that are payable per unit of certain or some goods and services, such as what? Value added tax, import duty tax, sugar tax, sin tax. Those are some of the taxes that you and I, because they affect us, that means these are the taxes that are payable to the final goods and services at the end of the day. So for 2 marks, you may be required to briefly describe any of these concepts, or we can give you the definition or the concept, and we want you to provide us with the terminology on the other side. Okay? Or we may say, briefly distinguish between taxes on production and taxes on products. So you'll tell us that the taxes on production are not linked to any specific good or service, while the other ones are paid per unit. Then you also provide examples there. Under production, you'll tell us that it's taxes on things such as land and buildings, while under the products, you can mention all the other form of taxes that we know. Value added tax, import duty tax, the sugar tax, as well as the sin tax. Then we've got what we call intermediate goods and services. These are used as inputs to produce other goods and services. They are known as goods, but they are used in the production process. We call them a system, or we call them an input, so that we can have an output on the other side. Things such as your equipment. Someone can use the equipment for something else, but we know that this equipment, we use it to produce other final goods and services. So those are called intermediate goods. Then we've got what we call the gross fixed capital formation. Here it refers to the purchasing of capital goods by either the firms or the state. Gross fixed capital formation. It's investment in capital goods. Sometimes it has got the letter I on it. That shows that we are investing or we are purchasing these capital goods that we are going to use in the production process to produce other goods and services. Then we've got what we call the consumption of fixed capital. Here we say that is the reward that must be paid to the owners of the fixed capital that has been used in the production process or in producing of final goods and services. Then we can also say it is the consumption of capital. It is the depreciation when this equipment that we're using as an intermediate good, as it keeps on depreciating at the end of the day, that is called consumption of fixed capital. And in accounting, we know that depreciation is the loss of value of assets. But those assets, they are not just idling there. They have been used to produce other goods and services. So that reward must be paid to those who own this fixed capital. Factor cost represents the amount received by various sectors of production. It means businesses, government, as well as the foreign sector. As you remember that households are the owners of factors of production. So we need to check as to say, when households render their factors of production to the other participants, how much were they paid? That is called what? The factor cost at the end of the day. So it represents the amount that was received by the various factors of production. Again, we repeat grade 12 that these concepts will assist us, because if you look at all these concepts, they are attached or they are part of the 3 methods of calculating GDP. So the examiner can pick any concept from the 3 methods of calculating GDP to say, briefly describe the concept gross fixed capital formation. So if we don't read or we don't break down these concepts, it will be difficult for us to get even these marks that we are saying. Those are the given marks in economics. Remember the first 4 marks of a data response. 1 mark, 2 marks, of which the middle part there, the mark says briefly describe the concept. So if you see concepts such as consumption of fixed capital formation, then you will be able to say, I remember this. If you see concepts such as cross fixed capital formation, purchasing of capital goods by firms and the government, that gives you straight 2 marks. Okay. So we need to therefore identify or distinguish between what we call the real flow as well as the money flow. Okay. So in the exchange process, there are two components, namely the real flow as well as the money flow. Under real flow, what is covered? We see households, after receiving their income or remuneration from firms, what do? They go to the product market and purchase what? Goods and services. So those goods and services that we see, such as the TV, such as the cars and everything that we see, those are what we call real flow because we can physically see them. Okay? It means these are the assets that are there. These are the assets that we can see. It's the real flow there. And also, other real flows are the factors of production. You can see labor when they go to the firm and work. You can see someone at the end of the day or in the morning. You see a person waking up, leaving their house, going to work. So the movement of these factors of production are also classified as what? As real flow. Okay? And then the physical exports and the physical imports of goods and services, those are also known as what? As real flow. Okay. Then under money flow, this is the earning of money or an income. In the morning, I said you see one of the factors of production there as what? As labor going to work. But do you see how much they earn, or do you know when they are paid? Do you know how much are they paid? You don't see that. So that movement of money there, or the earning of income, it is called what? The money flow, because it's not physical, it's intangible in other words. Then number two, we see where payments are made, the spending, where businesses spend in purchasing factors of production, that is money flow. When households purchase or spend in purchasing goods and services, that is also money flow. You can only see after that there was spending that took place here. Why? Because of the real flow. Okay? And then also you can see that there's an income that was received here because of the real flow. So these ones that we cannot physically see, the movement of payment as well as the movement of income, those are also known as what? As money flow. The 12 learners are once in model of circular flow based on different textbooks. A learner once said, no, the bold one, it's real flow, while the dotted one, it's money flow. We don't ask those questions in economics. We don't ask you which line is bold, which one is dotted, but we say you should know them to say the movements that are physically there, that you can see, it is called what? Real flow. The one that you cannot see, intangible one, is called what? Money flow. So when we say distinguish between real flow and money flow, you cannot tell us that there's a bold line or there's a dotted line, but you need to tell us that the movement of factors of production from households to the other participants, it's real flow. The purchasing of goods and services from the firms through the product market to the other participants, it's real flow. But the payment for purchasing these factors of production, it's money flow. The income that is earned by these factors of production, it's money flow. Okay. Then we get to the system of national accounts aggregate, where we say the national accounts aggregates are methods that are used to determine the value of economic activities. We use the following methods to calculate the value of economic activities at market price, where we use the production method, the income method, as well as the expenditure method. One word or 1 mark answer. Name any method of calculating GDP, or name one method of calculating GDP. Remember the pie. You can say production method, or you can say the income method, or the expenditure method. Again, grade 12, now that we are revising for our exams, we cannot be where the question says list one, because you think that it's easy, you list all three. We're not going to mark the other two, or the other two are not going to be allocated a mark. So save time. These ones, the first marks or the first questions are usually hanging fruits. So when we say list one, name one, provide one, just provide that one. Do not provide any other, because we're not going to mark them at the end of the day. Okay. These methods are all used at different times for different purposes for that matter. Okay. Then all the countries use national accounts figures. South Africa uses the system of national accounts SNA as prescribed by the United Nations. I've repeated that the GDP, the GDE, as well as the GDI have a great deal to deal with the prices that we use, such as the nominal and the real prices, or prices before tax and prices after tax. Because we calculate GDP at market price, we calculate GD at market price. We want to check to say how much is the product after it has passed all the stages of production, where taxes are being added and where subsidies are being subtracted at the end of the day. Indirect taxes as well as subsidies are the most important determinants of the end values of this national accounts aggregate. We're going to be showing you that in a table format to say how do we derive the GDP at market price using the production method, how do we derive the GDP at market price using the income method, as well as using the expenditure method. Okay. Now here we are looking at what we call the conversion of domestic to national figures. You can recall that when we started our lesson grade 12, here we looked at the domestic figures as well as the national figures. Let's just recall, we said the domestic figures, or the GDP, gross domestic product, we said is the value of all final goods and services produced within the borders of a country. That includes everyone who's working in South Africa. Okay? And then the national figures now, we mentioned that those are the value of all final goods and services produced by, the keyword there was what? Permanent citizens. Okay, so we look at domestic figures, it's anything that is happening within the borders, but the national figures relate to income or production by only the citizens, whether they are within or outside our country. Okay. Then let's look at how do we do it in a calculation format. Okay. You'll take your gross domestic product at market prices. Then you factor income from the rest of the world. Okay. Then you minus factor income to the rest of the world. Then the final answer, you'll get what? The GNP at market price. Let me stop there for now. There's a keyword here, from, and here to, right? The GDP of a country, it includes everyone who's in the country, whether you are a citizen or not. But does that assist us? The answer is no, because at the end of the day, we need to subtract the factor income to the rest of the world. It means we need to subtract anyone who's not a citizen. But we find out that the same thing that we are doing in South Africa, that is what Australia is doing. Australia's GDP focuses only on citizens, focuses on domestic GDP, would focus on everyone who's in Australia, whether you are a citizen or not. But the national figures of Australia will focus only on what? Permanent citizens of Australia. Same applies with South Africa. South Africa, when calculating GDP, it's everyone who's in South Africa. But when calculating the GNP, focuses only on what? On citizens. Now the question would be, you've got a Swaziland or Botswana person working in South Africa. That person, you would have subtracted the factor income so that you can get the GNP. Their income is added in Botswana. A South African person who's in Australia, for Australians to get their GNP, they would have subtracted that South African person. So their income now is added in South Africa for that matter. Okay? So here, from the rest of the world, it means these are SA citizens. Okay? In other countries as well. For the rest of the world, these are non-citizens in South Africa for that matter. Okay, these are the non-citizens in South Africa. So they are subtracted. We only focus on what? On citizens. A question that we usually see in exams commonly, they will ask you, why is the GDP at market price in South Africa always greater than the GNP at market price? Because sometimes when we see the GDP value will be so much, it will be 100 million. But after we add the factor income from the rest of the world and we subtract the factor income to the rest of the world, we get a small figure, around 100,000. So the question would be, why? Your response is this one, grade 12. You will tell us that in South Africa, there are more non-South African citizens working in the country than South Africans themselves working in other countries. Don't know if this makes sense. The GDP figures are always greater than the GNP figures in South Africa. So in the exam, we ask you to say, why is that the case? Then your answer would be, here in South Africa, we've got more non-South African citizens working in South Africa than South Africans themselves working in other countries. For example, if you look at, if we can maybe compare Botswana and South Africa, and then we check to say, how many of those Botswana citizens work in South Africa? The answer would be many. But the question would be, how many of the South African citizens work in Botswana? The answer will be few. Therefore, the factor income from the rest of the world, it's always less than the factor income to the rest of the world. Hence, the GDP values are much greater than the GNP values. Okay, hope it makes sense. Then in the circular flow, we identified what we call the leakages as well as the injections, where we said leakages represents the withdrawal of money from the economy or from the economic cycle, while injections represents the injection or the introduction of money into the economy. The leakages does not assist the economy as such because it does not give a further round of a rise to a further round of income, because that money goes out of the economy rather than circulating in the economy. Unlike on the other side of injections, to say it represents the flow of any spending which is not derived from your income, the consumption in terms of purchasing goods and services, the spending by the government, the investment by firms, as well as the earning that were received from exports. Okay? So once there are leakages taking place, the domestic purchase of goods and services do what? Decline. So here we say we see a decrease or the withdrawal of money from the economy, which does not give rise to a further income. And because money goes out of the economy, by default, the purchases of goods and services locally or domestically decline. While on the other side, that injection is the money that enters the economy and it increases the what? The income in the economy. Okay. In an open economy, leakages are taxes, expenditure on imports, as well as savings. I want to emphasize especially on this one. Imports themselves, grade 12s, are not leakages because these are the physical goods coming into the country. But what makes the leakage here is the money that is used to purchase those imports. Okay? So here's the question in the exam. Name any two leakages in the circular flow. Taxes. We'll give you a mark for that. If you write imports, you lose a mark. You should say expenditure on imports or payments for imports. Because we are referring to the issue of money here, not the goods themselves. The goods, if I'm a South African citizen and then I buy a sneaker from America, that sneaker itself will come to South Africa. But what happened to the money? Did the money circulate in the economy? No, the money went out. So hence we are saying the payment for imports, it's a leakage, not imports themselves. Okay. Also savings, the money instead of being used to spend to purchase goods and services, I take it to the bank. It's stored in the bank. It may be accumulating investment, yes, but it does not give a rise to a further income in the economy. So what are leakages? Leakages are the withdrawal of money from the economy. Okay, that's the definition. Name any two examples of leakages. Savings, correct. Taxes, correct. Number 3, payment for imports or expenditure on imports, not imports themselves. On the other side, injections there are the government spending. Look at how we put it. The revenue that is earned from what? From exports, not exports themselves. Exports are the physical goods that we as South Africans take to other countries. But what are we receiving? Money that is entering the economy that is going to circulate in the economy at the end of the day. Then again, we see investment spending. Okay. So those are some of the terminology that we see as technicalities that make you to lose marks. Exports themselves are not injections, but the revenue received from selling those exports, it is injection. On the other side, the leakage, imports are not leakage, but the payment for imports are the leakages. Okay. All right. So in summary, leakages, it's the taxes, the imports, expenditure, as well as the what? The savings. Then we said the leakages relates to the withdrawal of money or outflow of money from the circular flow or from the economy. The injections on the other side, these are the government spending, export earnings, as well as what? Investment. And that refers to an inflow. Okay. We are always satisfied with this grade 12s, but usually on this ones, because from the lower grades you knew that no, exports are injections and imports are leakages. But in reality, the exports themselves are the physical goods, but the earnings from there, that is the money that we are referring to. Markets in the circular flow, which is one of the essays that was identified as per the 2021 exam guideline. First market that we get is the factor market, where factors of production are traded. These factors of production includes land or natural resources or raw material, the capital, labor, as well as entrepreneurship. These services earn what? Wages, interest, rent, and profits. You see the way they are. So it means the labor will earn what? the wages, the capital will earn the what? The interest, because it's the money that you've placed, and the natural resources or the land will earn the what? The rent. As an entrepreneur, your primary goal is to make what? Profits. So those are the associated parts there. Wages goes with labor, interest goes with capital, the rent goes with land or natural resources or raw material, and the profits are associated with an entrepreneur. So examples of the factor market are the labor market. I'll make an example. As a person, if I need employment, I will therefore go to the factor market and say I'm available for employment. That's the labor market. And then a business who needs the certain skills will also go to the factor market and advertise to say we need certain and certain skills on the other side. The other one is the property market, where there's a selling and buying of the property. Then also we've got what we call the financial market. The main purpose of the factor market is to channel the factors of production from households who are the owners of those factors of production to the businesses so that production of goods and services can take place. So that tells you here, grade 12, to say without these factors of production from households, the production cannot take place because they are the owners of factors of production. But in grade 12, we want you to tell us how does that relate to the factor market. We cannot only say discuss the characteristics of households or the characteristics of firms, but we want you to tell us how does this pass through the what? The factor market. Then I want we say it is the product market or the market for goods and services. These are the markets for consumer goods and services, where we say buying and selling of goods that are produced take place in this market. For example, consumer goods. Okay, while we are here, when we were explaining the issue of currency depreciation and currency appreciation, we distinguish between capital goods as well as the consumer goods. On the capital goods, we mentioned that these are the goods that are used to produce the other goods and services, such as equipment, petrol, and everything. The consumer goods are the final goods and services that you and I spend our money on. So these consumer goods are classified into three plus the services that we spend our money on. The first one is the durable goods that we say they last for a longer period of time or they've got a long lifespan. And we've got what we call semi-durable goods. They do last but not that long. Then we've got what we call non-durable goods, where we say the consumption is immediate. I'll make an example. If you buy airtime now, then that airtime, you punch the number star, what, you put it in your phone. Tomorrow morning, you cannot go and get that paper again and punch it again. The consumption is already finished. Okay. But if you look at a car, the car is usually, we say it's durable. It's a long term. You can use it more, and more. And then semi-durable goods are things that we use them, but not for a longer period of time. Where do we spend our money on in terms of services? Services such as education, the issue of transport, the issue of healthcare. Those are part of the services where we spend our money on as what? As the consumers. Where will we get that? In the product market or in the market for goods and services. Okay. Capital market. Here we look at where long-term funds are borrowed and saved by consumers and the business enterprises, such as the mortgage bond. Okay. And the JSE, it is the key institution in that capital market because the investment is a long term. Where you save money, you save it for a very long term. Even the borrowings, if you borrow for a long term, that market is classified as the what? As the capital market. Okay. Then we can also trade shares in that particular market. Such as, we made an example here where we look at the issue of the mortgage bond. Mortgage bond is around 10 years, 18 years to 20 years in terms of the long term. So that is what we call the the capital market, grade 12. The opposite of capital market or close to capital market is the money market. Here we are looking at the short-term loans as well as a very short-term funds are saved and borrowed by consumers as well as enterprises. So in other words, it's the opposite of the capital market. Under this money market, we will get the banks, insurance companies, etc. All those are the ones that operate where there's just a movement of money in that, but it is not a very long term. You go to the bank, you borrow money, you're going to pay it around 24 months or even less than that, 6 months. And insurance company, you are covered as you go. You cannot be saying, I'm covered for a lifetime on the other side, on your car or on your house. You pay it. If you break the premium, you are no longer covered. So that is known as the money market. Okay. All right. Examples of resources that are traded there. We look at the issue of debentures, treasury bills, as well as the issue of government bonds. Those are the good resources that are traded there. So here, the tricky part or something that we usually ask you, grade 12, is to say, give us examples of commodities that are traded in the capital market. You tell us that shares are traded in that one. Then on the other side, we ask you, well, we can say treasury bills or government or bank debentures. In which market are they traded in? You need to know that they are traded in the money market. Okay. Then we get to the foreign exchange market. This is very important because this foreign exchange market links us to topic number 4, where we did currency appreciation as well as currency depreciation, where we need to determine the buying and selling of imports and exports. Then also, it is very important because when we do inflation as well as indicators, under economic indicators, we've got what we call foreign trade there. So that is very, very important that we are looking at the grade 12s. Okay? Businesses buy foreign currency to pay for imported goods. Those are the factors that will cause us to go to the foreign exchange market and demand the foreign currency. It is because we want to import those goods and services. Which market will make it possible? The foreign exchange market. Okay, in South Africa, we fully understand that these transactions occur in the banks. So if you go to the bank, you want to exchange the rands into dollars, they will assist you with that. You want to exchange the dollars into any other currency, they will assist you with that. And also if you go to the airports and elsewhere, we've got that. So in the foreign exchange markets, we're looking at things such as the London, the New York, as well as the Tokyo market. And South African rand is freely traded in this market because we are using what we call the free floating exchange rate system, where there is no government intervention, or the SARB has no control over that market. The nominal values as well as the real values. Nominal values or figures are also known as the money value, while the real values are also known as the national product at constant prices. Okay, on the other side, we say these ones are the current prices. So in our exam guideline or in the previous exams, we ask you in this way: briefly describe the concept constant prices, or briefly describe the concept current prices, or distinguish between constant prices and current prices. What we get when we write, because someone is thinking, oh, it's current, and these are the prices for today because they are very current. That is not how we use it in economics. Then you see the word constant prices, you say constant. It means these are the prices that are constant. They are not moving. No, that is incorrect. You're not going to get marks for that. But let us understand. The constant prices are the prices where inflation or the rate of inflation has been taken into account or has been considered for that matter. While on the other one, the nominal value of production is calculated by multiplying the volume of the final goods and services by their price. On the other side, the real value of productions are the nominal values of the national product adjusted for price increase. In other words, in the current prices, inflation has not yet been taken into account, while on the other side, inflation has been taken into account. Sometimes we ask you this way: which one do you think we are going to prefer here as economists when we are calculating GDP? We're going to be focusing on what we call the real values, but we're not going to tell you real values. We are going to ask you to say, why do economists prefer constant prices than current prices? Then what you write, you'll be saying, no, they will prefer constant prices because these prices are the same. They are not changing. It's not the answer there. You tell us that it is because here they've been adjusted for inflation. That means inflation has been taken into account. On the other side, inflation has not yet been taken into account. Okay. Methods of calculating GDP. We are adding now. Where we start with the factor cost. This factor cost is used in which method? In the income method, when we are measuring economic activities. So how do we get that? You will take GDP at factor cost or gross value added at factor cost, add taxes on production minus subsidies on production, then you will arrive to a figure that is called what? GVA or GDP at basic prices. Then we move now. The basic prices are used in which method? In the production method. We add the taxes on production, we minus the subsidies on production, and therefore these are part of the examples that we've mentioned. Then that will give us the GDP at market prices. We have mentioned these taxes on production, such as payroll taxes or site or pay as you earn. Then also we mentioned subsidies on production to say this include employment subsidies or subsidies that are paid to prevent what? Pollution on the other side. Okay. Market prices, how do we get the values? You take GDP at basic prices plus taxes on products minus subsidies on products is equal to the GDP at market prices. Okay, remember, why did we start grade 12? We started at the factor cost, where we said GVA at factor cost, you add taxes on production, you minus subsidies on production. Then it will give you what we call GDP at basic prices. Once you arrive to GDP at basic prices or at market prices, then you will take the taxes on products, they are added. You minus the subsidies on products, then they will give you what we call GDP at market prices. Then I always say, for us to remember this, what do taxes do to the value of the product? Do taxes increase the value of the product or decrease the value of the product? The taxes, what do they do? Definitely, if there was no tax, it would be cheap for us to buy the products because that increases the value of the product. So in your mind, sitting there, you know that I must always add what? Taxes. Whether it's tax on production, it must be added. Subsidies on taxes on products must be added. Let's look at subsidies. What do subsidies do? Or what is the main aim of subsidy? It's to encourage production and also to reduce the cost of the product. So subsidies on production will be subtracted, subsidies on products will be subtracted on the other side. Then we will be left with what we call GDP at market prices. Okay, I've mentioned that to say in full now, you take your GDP at factor plus other taxes minus subsidies. It gives you a GDP at basic prices. You add taxes on products, you minus subsidies on products, then it will give you what you call GDP at market prices. So this is a complete formula there for grade 12s. Okay. Then let's look at the production method, where we said the production method, it is whereby we determine the gross domestic product at basic prices by adding the final value of all goods and services produced in the three sectors of the economy: the primary sector, the secondary sector, the tertiary sector. Now here's another advice here. Another question we ask you: which method was used to calculate GDP above? You will see it when you say it's a production method. How will you see it? If it has what? The primary sector, it has what? The secondary sector, and also has what? The tertiary sector. Once you see those three sectors of the economy, then you know that this is the what? The production method. Then another question that follows that say, name any other method of calculating GDP. 1 mark. You cannot list two because it's only 1 mark. Already you've identified that this one is the production method. Remember pi? You already have identified that this one is the production method. It means you can write income method or expenditure method. Don't write income method and expenditure method. We just send them any other. For how many marks? For 1 mark. So always what I'm trying to say here is that pay attention to mark allocation. Okay. In the national accounts, the gross domestic product at basic prices is usually referred to as GVA at basic prices. So we might give you a table and then we put a question mark and then we say what is labeled by A. Then you can tell us to say it is GVA at basic prices or gross value added at basic prices. The income method. This income method, it is whereby we determine the gross domestic product. We take GDP at factor cost or at factor prices by adding all the other income earned by the factors of production. Then in the national accounts, this is referred to as gross value added at factor cost. Then we look at consumption or compensation of employees there. And then you look at the profit that is earned. Also, you look at the gross fixed capital formation. That is our income method. The expenditure method, it is the method where we determine the gross domestic product at market prices by adding the spending of the 4 main sectors in the economy, namely consumption by households, expenditure by the government, investment or gross fixed capital formation. And then we also look at the situation where we say the net values. Remember the foreign sector or net figures, exports minus imports. So when you see this, you know that here we are looking at which method? The expenditure method. Okay. So the differentiation between the GDE and the expenditure on GDP, where we say the gross domestic expenditure, we look at consumption by households, investment, as well as government, where the final one, the final answer, now we're going to be considering the fourth participant, which is the foreign sector. Here we are looking at the net values, exports minus imports on the other side. Okay. Then there's this other item or name that is called the residual items. This one, it helps us to do what we call reconciliation. For those learners that usually do the commercial subject, there's what we call the reconciliation when we check errors and omissions so that everything can be balanced. So this residual items makes provision for possible errors or mistakes or omissions that could have been made in the calculation of the expenditure item, because it's very difficult also to look at the expenditure items or to use the expenditure method. Therefore, we use what you call the residual item. It is used as a balancing figure to correct errors and omissions. Those are the key words there. Okay. If you look at this, at times the examiners won't put this, but they can ask you, which method is used to calculate GDP here? The answer is the production method. How do you see that? By the three sectors of the economy. Then I said wherever you see taxes, you add. Where you see subsidies, you do what? You minus. Okay. Income method, compensation of employees, which is here. We know that employees is what? It's labor. Remember the wages that we talked about, that this will receive what? The wages. Net operating surpluses. So this net operating surpluses will be saying there is what you get as the profit or the reward that you are having. And then here we are looking at the interest because of the capital that we would have invested there. Okay, then this is the long one, because after that it will give us gross value added at vector cost. Once you add the three, then you add taxes on production, you minus subsidies on production, it will give you GVA at basic prices. Then you add taxes on products, you minus subsidies on products, then it will give you what? GDP at market price, of which this is what we are calculating, or this is what we need. Now here's the catch while we are still here, grade 12s. Sometimes this GVA at basic price could be a question mark or could be blank, and they could make it A. And then the question would give you values from the bottom up until up there. You do the opposite of what you did when you're going down. There's something that is called bottom-up method, where you are going to say, I'll take my value at market price, which is 1,523. When you're going down to get the market price, what did you do? You subtracted. But now because you are going back, what are you going to do? You're going to add. Okay? Then taxes on products, when you were going down, what did you do there? You were adding. But when you go up, what are you going to do? You are going to minus. So that's the catch there. We cannot add. Even when you go up, we're still adding. We do the opposite now. We apply what we call the bottom-up method. Any question can be, any value here can be placed as a question mark. Just know to say when I'm going down, I'll add the taxes and then I'll subtract the subsidies. But going back, I will add the subsidies and minus the taxes. Then again, there's something that we call percentages, where you are asked to say, calculate compensation of employees as a percentage of GDP at market prices. So you'll take your compensation of employees figure there, which is 680. Then you divide it by 1,523. Then you multiply by 100, because you want it as a what? As a percentage. And then the value that you are getting, we need to get to say how much does compensation of employees contribute to the GDP at market prices. So be careful when you are reading these questions. Do we want it in a percentage form or in a value form? Okay. The expenditure method, remember we said this one we look at final consumer spending, which is the consumption by households, which is the letter C. Final consumer spending by the general government, that one takes the letter G. And gross fixed capital formation, that takes the letter I. Then the residual item, remember we said it is used as the balancing figure or to correct errors and omission. If it is positive like this, you take it the way it is, you add. If it was a negative, you're going to do what? You are going to minus. Okay? Then down there, it gives us what you call the GDE at basic prices or gross domestic product or gross domestic expenditure at basic prices. Then what do you do then? After that, you add your exports, then you minus your imports there. Remember this one, we said the exports take the letter X and then the imports take the letter M or Z based on different textbooks that we are having. So in other words, grade 12, if you see the formula C plus G plus I plus open bracket X minus M, we know which method is that? The expenditure method. If we see compensation of employees, net operating surpluses, as well as consumption of fixed capital formation or fixed capital, we know that it's the income method. A situation where we see the three sectors in the economy, the primary sector, the secondary sector, as well as the tertiary sector, we know there that we are calculating using the production method. At the end of the day, grade 12, the GDP at market prices should be the same. If you look at with the previous example that we're showing, still the GDP at market price was how much? Was 1,523. So all the three methods of calculating GDP at market price, the final answer should be the same. Hence, if there are errors and omissions that are taken there, they will be covered by what you call the residual item. Still repeat, the residual item, it is to correct errors and omissions that were done when the expenditure method was used. Again, percentage, you check what is given and you underline here, calculate something as a percentage of something. Okay, let me put it in terms now. Calculate gross capital formation as a percentage of GDE at basic prices. So the one that you are calculating is at the top. So you'll take the gross capital formation amount, which is 280 or 278. Then you divide by 1,545 multiply by 100 there, because they've given you to say calculate gross capital formation as a percentage of GDE at basic prices. Then you'll get your marks there and you get your values in percentage forms. Okay, right. We've got an activity here that was taken from the Free State prelim. It was question 2.2 there in 2024. And they are just, remember, before you do this, we always say analyze the data response first, the diagram, before you can even attempt to answer the question. Some of the questions you'll answer before you can even attempt. So may we please do this for 5 minutes, starting now. All right, grade 12. Let's just look at then the questions as well as the possible answers. But the approach would still be, before we can attempt to answer questions, is to analyze the data response. So if we can see the top part there says rest of the world. Then here we've got what you call household. And then in the middle there, we've got what you call the government. And then down there, we've got what you call the firms. So how many of these participants are circled? 4 already. So automatically you can think to say, what kind of economy is this? The one that has 4. Then let's look at the movement now. We don't have dotted movement, or we don't have arrows, no, bold movements, but we can see arrows here. So we see a line from the rest of the world coming here where there's a purchases there. That means there's a spending. And we also see households going to the rest of the world purchasing. Again, it's spending. We see taxes from households to the government. We also see taxes from firms to the government. Then for rendering the factors of production, we see remuneration or income that has been paid to the households, and also government, after collecting tax, pay wages, or also what we call transfer payments. So that is the movement that we are seeing there. So there's the purchases, and also there's the income that we are receiving. Okay, then we can move to the questions. Question 1. Identify the type of economy that is illustrated in the diagram above. The answer is an open economy. So if you've got your mark there, or a 4-sector economy. This is one of the hanging fruits that we're talking about there. There are 4 sectors or 4 participants. It's open. Only 3 sectors, it's a closed economy. Okay? Which flow is not indicated in the diagram above? I just saw the purchases of goods and services. I saw money coming from the firms to households, but I did not see household goods and services. I did not see movement of factors of production. So it means the one that is not there, it is the real flow. Another mark for us there. Briefly describe the concept of circular flow. It is the diagram indicating the flow of the pie, the production, the income, as well as the expenditure in the economy. Okay. Why is the gross domestic product always greater than the gross national product? You see how they ask it here. Because when I was explaining it, I said the other way around. Why is the GNP values less than the GDP values? This way, now they're asking you to say, why is the GDP values in South Africa greater than the GNP values in South Africa? And now we've got marks there. You've got foreign nationals that are contributing more in South Africa than South Africans in foreign countries. Or you could be saying that we've got more non-citizens working in South Africa than South African citizens working in other countries. That is the reason there. And South Africans are spoiled with job choices than the foreign nationals. Hence, they're working in South Africa because of those job choices. But South Africans, because there's choices of jobs around, sometimes they see no need for them to go to other countries to look for employment. They are based in their own country for that matter. But the first one is 100% correct. Also, we look at the mark allocation there. There are more non-South African citizens working in South Africa than South African citizens working in other countries. Then the last one, it's a suggestion-based, it's opinion-based. What measures can the government employ to ensure that money does not flow out of the country easily? It means, what can the South African government do to ensure that we don't depend more on imports? Because we realize that a payment for imports becomes a leakage. It's a withdrawal of money from the circular flow. It does not help us. So what can the South African government do? The government can invest more in healthcare and education to enhance the skills needed the most by the economy. Intensify partnerships with the private sector to induce workers high productive levels, that's leading to more growth in the economy. And also they can undergo what we call more foreign direct investment. What we mean by this foreign direct investment, what this what South Africans are buying from other countries, let it be produced in South Africa. So we attract those companies that are outside to come and start their own businesses where in South Africa. In that way, the availability of those goods and services that are usually demanded by South Africans at the point where they even import them. If they are produced in South Africa, then it's easy. Money will remain in South Africa for that matter. The other one, restructure and formalize ownership developments to minimize the flea market, where we see dumping coming into South Africa. Other suggestions could be saying, let the government increase taxes on imports or increase custom duty tax that will discourage consumers from buying from other countries. Although we know the after effect is that those countries will also retaliate by increasing taxes as well. But that can be the measure that is employed by the government to make sure that money does not easily flow to other countries on the other side. Okay, because here on the first one, in terms of skills, could be that we are not producing what is required here, and therefore the consumers buy it from other countries. But if skills are there, then we can specialize in that. Okay, right. The last one, it's taken from the Northwest 2024 prelim, question 2.2 again, this circular flow. Okay, this one, because we have done the other one, we can allocate 4 minutes on this one. Okay, grade 12, so welcome back. Um, let's just look at this, and then we see there that there's compensation of employees. So this compensation, it means we have been paid as an employee, and the factor of production there is labor. Okay. Then we are looking at 2022 as well as 2023. So the first question starts to say, which method was used to calculate or to determine GDP in the diagram above? The answer there would have been the income method, okay? Because it's compensation of employees. The second one says, give one type of taxes on products. It's the value added tax, the excess duty tax, the import duty tax. Those are charged on products. Those are the marks that we are saying we have there. The other one, briefly explain the term basic prices, where we are saying these are the prices. We'll start with the second one. These are the prices that include taxes on production and exclude subsidies on production, or the prices before taking into account taxes on products and subsidies on products. Or in a long definition, it refers to the prices used when calculating GDP according to the production method and represents the production cost of the firm. But of which I know, I would say that let's prefer this one, the short one. Basic prices are the prices that include taxes on production and exclude subsidies on production. Or alternatively, you could be saying these are the prices that are there before taking into account taxes on products and subsidies on products. Okay. The other one says, explain the impact subsidies will have on production. What are subsidies and what impact will they have? Subsidies decreases the cost of production, which makes the level of production higher. Be careful here, grade 12s. We are not asking you subsidies on products, but we are asking you subsidies on production. Subsidies on production refers to talks to you and I, of which it will make the the prices of goods and services cheaper, so that you and I can be able to do what? To afford them. But subsidies on production decreases the cost of production and encourages the production to increase. Hence, we are saying here that the levels of production will be higher. The last one, determine the value of GDP at market prices in 2023, which is what? Which is A. We usually tell you that they'll leave it as A, then you need to calculate that. Okay. Now we are going down to get the market prices. What are we going to do? We are going to tell the examiner to say it is the GDP at basic prices plus the taxes on products minus the subsidies on products. In this way, we get what we call 5,952,708 plus 691,240 minus 15,398. It will give us 6,628,550 million. So if the cash is this one again, grade 12s. Show all calculations. Do not only provide the final answer. Don't punch you in your calculator and give us this, because you see that the final answer is only allocated what? 1 mark. So if you give us only the final answer because you punched everything in a calculator, or you wrote this in your answer sheet or in the question paper somewhere, then you provide the final answer, you would have lost marks there. So be careful when you're answering. Show all calculations as it is indicated here. That is what we are asking. And we want to say thank you for watching the lesson. See you next time, and